how to lower risk combining Nadex spreads with futures and Forex, how to protect your profits and let your profits run, how to scalp futures. Some of you are scalpers, some of you are more long-term trend traders. You can use it either way, and I'm going to show you briefly how to do that. What instruments you can trade these on, how many spreads you need to equalize spot Forex or futures position to hedge that position, and how we use NinjaTrader with this strategy. So I'm not going to bore you with a long history about me or any long sales pitches. I'm like I said, I'm going to jump in here. We've got quite a bit of information to cover. In fact, I'm not going to try to sell you anything at all today. I'll show you at the end here a free special offer that we're going to give you where you can download our toolkit, our Apex toolkit for Ninja for free. And there's no obligation, no credit card, no annual special offer. It's free for Ninja users, so stick around for that. Show you how you can download that and take advantage of a couple of our indicators. One in particular is our diagnostic deviation levels. Those plot directly on your NinjaTrader chart, and you can use them on over 22,000 instruments. And you don't have to be using a Apex system or strategy in order for these to be useful for you. They can fit right into whatever your current system or strategy or other indicators is. I'll kind of show you how powerful those are for us. But first, I want to talk to you about what we call the ultimate hedge strategy, which is one of our favorite hedge strategies all around. So first of all, those of you that are not familiar with Nadex, okay, first thing you want to do, hop on over to nadex.com, okay, and you can go through and get some information here about who Nadex is, what markets they offer, binary spreads, and so on. Today we're going to be talking about spreads. If you go right here to the trading tab, the third tab down says Demo Trading Platform. And if you don't have one of these, hop on and get one right now, even while we're on the webinar. It'll literally just take a second. All you got to do is select a username, enter your first and last name, phone number, and email, and press Apply for Demo. Okay? And here in just a moment, you will get an email with a temporary password, and you'll be able to log right in. And Nadex will give you a $25,000 demo account for free. All right? And you can hop in there and get familiar with the Nadex platform, how to use it, what instruments they offer, entering and exiting tickets, entering orders. Get familiar with it with your demo account. All right? And right here you've got all of your basic, right here's all your instruments, and you can go in and select. For example, if we wanted to look at some Forex spreads tonight, we've got different Forex pairs here. We can click on that pair and find the different spreads and so on. Okay, so hop in there right now, get a free demo account with Nadex, and like I said, they'll give you a demo account for 2 weeks free. Once you open a live account with Nadex, and all that requires is a minimum of $100 to open a live account with Nadex. Once you have an account open, as soon as you place one live trade, doesn't matter if it's a $700 risk trade or a $7 risk trade, does not matter. Once you've placed one live trade with Nadex, you can call them and they'll extend your demo account for 1 year. That way you always have a live account and a demo account. Use that demo account to practice any new strategies or systems. But the strategy I'm going to teach you tonight, if you're already a spot Forex trader or a futures trader, hop on right now, get a Nadex demo account, and start demoing this tonight, tomorrow. You can use the demo account to practice this strategy that I'm going to show you tonight, and you'll see how it works for you. Then you can hop on and start doing it live. Okay? So hop on over there and get a demo account right away. Take advantage of that. $25,000 free demo account, no obligation there whatsoever. Okay? And then I'm going to talk to you a little bit more later about who we are at Apex Investing. Like you heard there in the intro, we're an educational company, a company of traders helping traders. We've got some live trade rooms. We've got a huge forum, literally hundreds and hundreds of hours of education. And I'll show you kind of towards the end where you can get some more information about this strategy and so on. But we're going to jump right in. And a couple trading tips. To make money in trading, you need to first learn 4 things. For one, how to reduce your risk. 2, increase your leverage. More time to be right. And a strategy that will let you limit your risks but allow your profits to keep running without giving them all back. Okay, we all know that. We've all struggled with that. And that's one of the big things that you'll see here in this strategy. So what we're going to do is going to go through this, take some notes. Again, this webinar is being recorded. If you need to watch it again, you can also find some more info on our website. I'll show you. We're going to take a moment here, and I'm just going to do a quick walkthrough of the basics of Nadex spreads, because some of you are not familiar with Nadex spreads at all. So I'm going to do a quick walkthrough of how Nadex spreads work, because you have to understand that first, how they work, before I can show you how to use them in conjunction with your current Forex or futures trading. Okay? So Nadex calls them bull spreads. We like to call them, they call them bull or bear spreads. We like to call them box spreads, because if you draw them on a chart, they look like a box. Basically, all a spread has a floor and a ceiling. Okay? So, quick example here. This is a little older here, but let's say this was a euro dollar. Let's say the floor of this spread was 1.2400. The ceiling of the spread was 1.2500. Okay? The spread is the difference between the floor and the ceiling. So ceiling is 2,500, floor is 2,400. We've got a difference of 100. All right, so 100 pips, 100 ticks, whatever you want to call it, the last digit quoted, moves in pips or ticks, the last digit quoted, okay? Each pip is worth $1, and there are 100 pips here in this spread, okay? So the spread value is 100 pips. Each pip is worth $1. Therefore, the spread is worth $100, depending on where you buy or sell into the spread. So, for example, if you're selling a spread, if you're going short, think the market's going to go down, you cannot lose money above the ceiling. All right? You're capped. You're capped risk and you're capped reward. So if you're selling, you cannot lose money above the ceiling. So if you're going short and the market pops up and it goes past the ceiling of 1.2500, you don't lose any money past that ceiling. You also can't make additional money past the floor. If you go short and you're correct, the market goes down all the way to the floor here, well, you make money all the way down to the floor, but if it keeps going in your direction, you don't keep making money below the floor. So let's look at an example here. Let's kind of piece this together. If you sold at 1.2490 and the ceiling is at 1.2500, all right, so what's the difference? 10 pips, okay? So if you sold and the market went against you, say you sold and the market went against you 100 pips, you can only lose 10 pips because you don't lose past the ceiling, all right? So each pip is worth $1. There are 10 pips, so again, the max risk is $10. No matter how far against you it would go in this sell situation here. So what if it does go in your favor? All right, you sold at 24.90. The floor, the bottom of the spread, is 2,400. All right, so 24.90 minus 2,400, 90 pips. All right, so 90 pips, each pip is worth $1. So your max profit potential is $90. So if you sold right here at 24.90, it went all the way down here to 2,400, you made $90. Again, if it keeps going in your favor, you don't make any more under, past your floor. But again, if it goes against you, you don't lose any more past the ceiling. Okay? So let's just look at a quick example the other way. If we're buying the spread, same thing. Can't make additional money above the ceiling, can't lose below the floor. So if, for example, we bought, again, we got a floor of 2,400, ceiling of 2,500. So if we bought at 24.10, thinking the market's going to go up, what happens immediately? Boom, the market goes down. All right, what's our max risk? Well, we bought at 24.10, sold at, or we bought at 24.10, the floor is 2,400, so we bought 10 pips away from the floor. So our max risk is $10. And you do not get stopped out. Spreads have an expiration time, okay? So you can hold a spread until expiration and it will close out, or you can close it early. But just because a spread hits your floor does not close the trade. The trade is still open. So when you buy here at 24.10, thinking the market's going to go up, and it doesn't, it goes down to your floor, you don't get stopped out. That trade does not close. It even goes down further than your floor. You're still in this trade at a what? $10 loss. And when it comes back up to the floor, then it comes back up to 24.10, then starts going up, 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 you're making $1 a pip all the way up. So it does not close just because it goes below your floor. It also does not close or kick you out just because it goes above your ceiling. Okay? The trade is still open. That's the beauty of the Nadex spreads. And we're going to see that here in a minute, how this ties in. So it does not automatically close just because it's a floor or ceiling. Okay? So again, each pip is worth $1, 10 pips there. If it does go all the way up to the ceiling of 2,500, again, we bought it 24.10. We've got profit potential all the way up to 2,500, 24.10, so 90 pip or $90 profit potential there in the spread. Okay? So there's an example of selling a spread and buying a spread. Basic thing you have to remember is any spread there is on Nadex, there's a floor and there's a ceiling. You can't make or lose more past the ceiling or below the floor. Okay, simple as that. Now, you can buy in anywhere in the spread depending on what time it is. All right, these examples we used showed buying or selling closer to the floor or ceiling. You can buy in the middle of a spread. All depends on where you're buying into this spread, where the market is at that particular time that you're getting into the order. Okay, so you can enter anytime and you can also exit anytime. You do not have to hold the spread until expiration. And again, remember our example when we bought right here at 24.10? Yes, granted, it did go all the way up to the ceiling, but we bought at 24.10. We could have got out at 24.60 for a $50 profit. We could have got out at 24.80. We could have got out anywhere we wanted to. Okay, get out anytime. Now, something to keep in mind with spreads, if it does go all the way up to the ceiling, we made our $90 max profit potential, correct? But what happens if it comes back down and we didn't close it out? Well, it's all about where we close it out or where it expires at. So if we bought for 24.10 and we just left this thing open, it went way up and then it came down and went way up and then came down and expired right here, say about 24.80. So we would have got the difference of 24.10 to 24.80, which would have been $70. We would have made more if we'd closed it out at the ceiling. So if a spread goes all the way to your max profit, there's no reason to leave it open. Leave it open. You can't make any more. All you can do from there is potentially lose if it goes against you. So it's best to close it out there. Okay? So we're getting a question here. Is there a time premium and expiration on these like options? Yes, Rick, there is some of that built in. I'm going to show you that a little bit here. There's different spreads to choose from. With Nadex, and I'll show you here in a minute, there's multiple time frames and multiple spreads to choose from, different width of spreads that are closer to the ceiling, closer to the floor, or right in the middle. Okay, and for example, your ones that are right in the middle are going to be the closest at the money spreads with very little premium. Okay, might have a tick or two in there, you know, depending on what you're trading. Some of the ones that are further away might have a few ticks in there, but I'll show you here in a minute how that works and where you can kind of see that very, very easily at a quick glance all on one page. So if the spread expires, it will close at the settlement price at that time of expiration based on the underlying market. Okay, so there's a bunch of different spreads that Nadex offers. They offer intraday spreads that expire every 2 hours, daily spreads that last up to 22 hours and 15 minutes. Now the larger time frames will be wider. They'll have wider floors and ceilings. Like if you looked at a oil spread right now on Nadex, it just opened up at 6 o'clock today, or for example, a ES. You look at an ES spread that opened up right now, a daily. It goes all the way until tomorrow at 4 o'clock. All right, so that's going to be a very wide, like hundreds of points spreads. But then tomorrow during the day, every 2 hours, there might be like 50-point spreads, 100-point spreads that start every hour. So you'll have the 50-point spreads, 100-point spreads, a big 500-point spread, all different ones to choose from, and then new spreads that are starting every hour. So there's always a bunch of different options there, okay? For example, here's what I mean, they'll overlap. So like during the day, for example, or even right now, let me just show you real quick here. See how this big spread here? This big spread has a ceiling of 1.3250. This one has a floor of 2750, so like 500-point wide spread, right? Then you've got this spread here that's 250 wide, and this one here that's 100 wide, and this one here that's like 200 wide. And you can get into any of these at the same time depending on how much time you need. Are you using a longer-term strategy, a longer-term trend strategy, or using a short-term trend strategy? Are you a part-time trader so you can only trade for a couple hours so you don't need a big long spread? Is there news coming out within the next hour so the move that you're trying to take advantage of is going to happen within the next hour or two, so you just need a short-term spread, not a long one? There's all different options there for you, okay? And for example, let me pull this over real quick here. Right now in the evening, let's just look at what we were looking at a minute ago, euro dollar. So 6 o'clock, the spread's open for euro dollar. So we've got a daily spread here that goes all the way till tomorrow at 3 p.m., okay? That's that big wide spread. You can see the floor is 1.0580, ceiling is 1180. So we've got, what, a 600-point spread there, okay? We've also got a spread that was, see this right here says 100 points. These spreads that go from 6 p.m. to 8 p.m., that's when they expire, is 8 p.m., these are 100-point wide spreads. And notice there's 3 of them, okay? There's also spreads from 6 p.m. to 11 p.m. that are 250 points wide. And again, there's 3 of them. Why is there 3 spreads? Work. What determines the spread? Okay, here's what happens. At 6 o'clock, for example, when these spreads opened up, okay, and here at 7 o'clock Eastern Time, some more spreads will open up, like a 7 p.m. to 9 p.m. And then at 8, you'll have an 8 to 10. So there'll always be multiple spreads, and they'll always have, and those will have different floors and ceilings. Here's how they're determined. When that spread opens up at 6 p.m., or here at 7 o'clock when the 7s open up, see right here it says these are 100 points. Well, let's look. This bottom one is what? 780 to 880. That's 100, right? What's this top one? 880 to 980. All right, you see this right here? The, oh, come on. All right. See this right here, the indicative? This is the Nadex indicative, what the current underlying indicative is. Just a couple of minutes before 6 o'clock, whatever this indicative is, there's going to be a spread that has a, okay, at 6 o'clock, the indicative was 1.0880. All right? So what they did is you have a 100-point spread that has a ceiling, a top of 0880 going down 100 points. Then you have a top spread that has a floor of 880 going up 100 points. Does that make sense? What it is at 6 o'clock or 7 o'clock or whenever the spread opens, if the market's at 0880, these are 100-point spreads, you've got 100 points going down, so ceiling is 880, the bottom is 780. You've got a spread up here that the floor, the bottom is 880, same number, going up 100. So you got one that goes down 100, up 100, and then one that's right in the middle, meaning it's split 50 down and 50 up. Does that make sense? That's why there's different spreads, okay? So also, see these 6 p.m. to 11 p.m.s? Those are the same number right here. They're based on 880, the floor and ceiling here. But they have different floor and ceilings here because they're 250 points wide. So at 7 o'clock, what will you have available? You'll have this one available with all these different spreads, 250 points wide. You'll have a 6 to 8, 100 points wide, both based on 0880. Then whatever the market is at 7 o'clock, you'll have new spreads that are 100 up, 100 down, and in the middle. Okay? So yes, the 6 to 11, does it mean it will expire at 11? Yes. Okay? 6 to 11, that one will expire at 11. 6 to 8 will expire at 8. Then in a minute, we'll have one that's 7 to 9. That's the expiration time. Okay? And you've got bid and offer. Okay? You've got different bid and offers based on where the market is compared to the floor and the ceilings. And you can determine what spread you want. Are you looking to hedge? Therefore, you're wanting one closer to a floor and ceiling, or are you trend trading? You want one in the middle. Just depends on what you're looking at there. Okay, so we'll cover this a little bit more. I just want to show you that there's not just one spread. There's a bunch of different spreads. That's how they're determined. You've got new spreads coming out every 2 hours or every hour, giving you a new floor and a new ceiling to use with the strategy we're going to cover. So what instruments can you trade with spreads? You've got not spot for it. Excuse me. You've got 10 different FX pairs. You've got commodities. On commodities, you've got corn, soybeans, oil, natural gas, copper, silver. You've got U.S. indices, the S&P, the NASDAQ, the Russell, and the Dow. You've got some international indices, the FTSE, the DAX, and the Nikkei. Okay, those are the instruments that Nadex offers these spreads on. So, what is the ultimate hedge? Now that you kind of have a basic understanding of how spreads work, you got a floor and your ceiling and a dollar per tick. You can do one spread, you can do 10 spreads, you can do 100 spreads. Okay? The ultimate hedge strategy is where we combine spreads with Forex, spot Forex, or futures to hedge. So let's take a look here. We're going to do a quick comparison real quick here. Let's say that we were trading spot pound dollar, okay? And let's say that we sold the pound dollar right here at 56.85. See that? Let's say we sold spot Forex pound dollar right here. Now, we want to place a stop somewhere, obviously, right? Let's say we put our stop up here at this red line of 57.50, okay? And that would give us a risk of 650 bucks if it went against us. And for margin, we'd put up about 3,100 bucks to place this trade. So what happens? We enter the trade because we're going short. We've got our stop placed up here. Boom. Market pops up. What happens? Kicks us out of that trade, right? We just lost 650 bucks. We had to put up 3,100, and we just lost 650 because the market went against us and hit our stop. Then what did the market do? Came right back to our entry and then kept on going down. But, so we were right. We were right. The market was going down. We sold for a reason. We thought it was going short. But what did it do first? Whipped against us, stopped us out, and then came back and went in our direction. I know none of you have ever had that happen, right? Yeah, we've all had that happen. Always happens. And you claim every time what? Man, I tell you, whoever's out there is after me. They're after my stops. I know they are. Because it goes all the way to my stop, and I get hit, and then it goes in my direction. Somebody's out there going after my stops, right? We all felt that way. So, we got in that trade. We had to put up $3,000 to do the trade. We lost 650 bucks, and then it went in our direction. Great. Okay? Let's just look at what if we were trading Nadex spreads as opposed to trading spot Forex. So, same situation. We were going to go short. We're going to sell. Well, I just showed you all the different spreads you can choose from, different time frames, new spreads will pop up, different floors, different ceilings to choose from all the time, based on where the market is. So if I wanted to sell, let's say I found a spread that had a ceiling of 1.5700 and had a floor of 54.50. So the 250 pip spread. So I found a spread with a ceiling pretty close to my entry. Okay? And let's say that I was able to, let's say that market was right here. Let's say I was able to sell this spread at 56.65, right here at this green line. But I didn't get in right at the ceiling. I got in right here because that's where the market was. That's where it was priced at. So I'm going to sell 10 spreads because, again, one spread, every pip is worth what? $1. So if I want to equalize it out to $10 a pip, like on spot or on a futures contract, then I would need 10 spreads, correct? So I'm selling at 56.65. The ceiling is 5,700. So what is my risk from here to here? 35 points, right? 35 ticks, right? So I'm going to do 10 spreads. So my total risk, therefore, is 350 bucks. Because if I sold right here, expecting it to go down, but it goes against me first, I can only lose money to the ceiling, and then I stop losing, correct? I'll lose dollar per tick to the ceiling, and then boom, I don't lose anymore, no matter how high it goes. So my risk is 35 ticks. I'm doing 10 contracts, so my risk is 350 bucks, not 650 bucks, like the example a minute ago. And with Nadex, your only margin, the only money you put up to enter a trade is your risk. Okay? So that 350 bucks is the only margin I'm putting up right here. So what happens? Boom, just like before, we sold here to go short. Nope, it went long. But what did it do? It went against this 350 bucks and then kept going. We don't lose anymore from here to here. So we have a ceiling, we have capped risk. We don't lose anymore. Also, what happened? I didn't close this trade. I went into it knowing my risk was 350 bucks. It went against me. I have no more to lose. I leave the trade open. I don't get stopped out. Because what can happen? Just like before, it came back in my direction, came back to my entry, and went on down here. And expired at 1.5589. So I actually made a profit of 760 bucks. So let's look at the two side by side. If I was trading the underlying spot Forex, I put up a risk of 650 bucks. Granted, you could have done a tighter stop if you wanted and lower that, sure. But we put a realistic stop there. I risked 650 bucks. I had to put up in margin $3,100 just to do the trade, and my result was I lost 650. With Nadex spreads, I got 10 Nadex spreads that equalized a spot contract there. I only risked 350 bucks. My margin was only 350 bucks. And because I was able to stay in that trade when it went against me and let it come back down, I was able to profit 760 bucks. Okay? So I'm not sitting here trying to tell you don't do spot Forex, don't trade futures, only trade spreads. It's not what I'm getting at here. Let me put it all together for you. But does everybody follow there the difference? Does everybody understand kind of the power now of the Nadex spreads having that capped risk on with ceilings? Because when it pops way up against you like that, you're not losing from here to here. You only lost from where you entered to the ceiling. All this is not a loss. So you can stay in this trade, let it come back for you, and come on down in your direction. Remember, one of the things I said earlier was more time to be right. Okay? Josh, there's no catch. That's just how the Nadex spreads work. Okay? Now, granted, this was getting a spread, has to do with getting the right spread. All right? I got a spread that was close to the ceiling. If I got into this spread, you know, way down here, and I sold it down here, and it went all the way up against me and expired up here, then yes, I would lose from here all the way up to here. Okay? It's a matter of getting the right spread. a spread that's close to the floor or ceiling for this strategy I'm going to show you. Okay, so let's look at one more quick example here. I showed you an example. Everybody understand it, right? I showed you an example a minute ago of doing 10 of these. But if I sold a spread and I just sold one spread, this is not an example of 10, this is one, okay? If I sold it right here, going short, I've only got $35 of risk to the ceiling. It pops up, now I only had to put up 35 bucks, okay? Pops up against me, I only lose money till right here. I don't lose money up here. I only lose money to right here. Then it comes back, boom, made 76 bucks per contract. The example before was 10 contracts, 760 bucks. All right, how do we put the two together? Okay, let's say that we were looking at this same trade. Okay, remember our trade here of spot Forex? All right, remember we sold here, expecting to go down, but it popped up against us. It knocked us out. Remember, because it went up. And as it went up, we lost 650 bucks because we got stopped out there. And then it came back for us. How can we get around that? Well, we can combine Nadex spreads with FX or futures, okay, on all the instruments I just told you about. The US indices, the DAX, the FTSE, the NK, Forex pairs, and certain commodities. So, the risk formula, when you're going long, the difference between where you buy the underlying and sell the spread is your risk. When you're going short, it's the difference of where you sell the underlying and buy the spread. Let me show you. So that same example we've been looking at, pound dollar, I wanted to go short, okay? Well, if I'm going to go short on spot Forex, or if I'm going to go short on a futures contract, what I could look for in my Nadex account, these would be two separate accounts obviously, I can look for a Nadex spread that has a floor close to where I'm selling Forex. Does that make sense? So let's say I found a spread that had a floor of 5,700 and a ceiling of 5,950. So the floor was at 5,700, went up 250 points. So I'm going to, let's say I can buy into this spread at 57.10, right in here. I'm going to buy 10 spreads at 57.10. What's my margin? How much money do I have to put up to get into 10 of those spreads? Well, if I'm buying at 57.10 to go long, the floor is 5,700, so I can only lose $10 per spread contract, correct? So I'm buying 10 contracts at 57.10, so it's only costing me 100 bucks in margin to get 10 of these spreads. Okay? So what am I doing? Boom. I remember I sold, what happened here? I sold my Forex, remember? I sold spot Forex. Boom, it went against me. Am I down 650 bucks like I was before and got stopped out? No, because guess what? I don't have a stop up here anymore. Why? Because as this contract that I sold goes against me, remember, because I sold, but as it's going against me up, I have 10 contracts that are making $10 a tick. So I'm losing $10 a tick on my sold Forex, but I'm making it back up right here. So I'm equalizing out. So I don't have a stop up here. I'm not going to get stopped out at 650 loss. I'm equalizing out tick per tick as I go up. And then what happens? It comes back down. Now my FX, my Forex contract, is going in my favor. And where did it go? Well, it went all the way down to 5589, and I got out with a profit of 960 bucks on my Forex contract. Remember what happened before? I sold Forex here, went up against me 650 bucks and kicked me out, so I lost 650 bucks on this trade. Then it came in my favor. But in this situation, what happens? I don't get stopped out up here because I have these spreads equalizing it out for me. And then, more time to be right, remember, comes back in my favor, and I get out here. So I have a profit of 960 bucks instead of a loss of 650 bucks. But I have to take out the cost of the spreads because my spreads cost me 100 bucks, and obviously it came down below the floor. So I take out the 100 bucks there, I netted 860 bucks profit. Now, the reason we got out right here at 5589, because that was when this spread expired. That was when my hedge expired. I could have stayed longer in this trade if it kept going down and made more. Does everybody understand that? How we got rid of that stop issue up here? By getting these spreads right here. So what is my true risk, in a sense, on this trade? Well, my risk would be if I sold my Forex right here, the market went against me, went against me, went against me, and then right here, my spread expired. So my only true exposure is this little gap right here, not 650 bucks. So see, I sold it right here at 56.85. Okay, and let's say that now instead of having my stop right up here where it was before, I really don't have to have a stop until 250 points way up here at the top of this spread because I'm equal out. I'm equal out. So really the only true risk I have here is if the market goes up against me and stays underneath this spread. Because I sold the spot at 56.85, I bought the spread at 57.10, that's a difference of 25 pips. That's my true risk now, is 250 bucks. Because below here, I'm covered making money. Above 57.10, I'm covered in equalizing it out. I'm not losing. Okay? So, like I said earlier, I was showing you a couple examples there, not to try to tell you, somebody asked, okay, what's the catch here? There's no catch. The catch is where you buy or sell your spread. I'm not trying to say don't trade Forex and don't trade futures, trade spreads. What I'm trying to show you here is how to combine the two. Whatever strategy or system you're already using, I'll show you here in a minute some of the ones we use here at Apex, but I'm not necessarily trying to sell you on our systems and our indicators here. I'm trying to show you whatever strategy or system you're already using to determine your trend trading of spot Forex or futures. You can start right away doing this. You don't need a new indicator from me or new system or to sign up for anything. The only thing you need to sign up for is a free Nadex demo account to start demo testing this and see how it works for you. And if you like it, open a live account with Nadex, start hedging your trades. Okay? So let's move forward here a little bit. So we went through all this. You understand now how if it goes against you, it's not knocking you out. You're not getting stopped out. You can keep let it going. So let's talk about some ratios here. How do you know how many spreads you need? Well, for example, if you're trading the ES it ticks in 0.25, ticks in quarters with a tick value of 12.50. So 4 quarters in a dollar, 4 ticks to a point, 4 times 12.50, 50 bucks. 50 bucks a point for ES, for example, right? Well, a US 500 spread with Nadex ticks in 0.1 with a tick value of $1. 10 times in a dollar, 10 ticks to a point. So you would need 5 Nadex spreads to hedge one ES contract. Where can you find that quickly and easily? I'm going to show you here in a little bit where you can hop over to our website, to apexinvesting.com, and get a free membership. I'm going to show you how to get some free stuff here. But one of the things we have is our scanners. Okay, right here I have a spread scanner. I'm just going to show you this one right now. We've got a new spread scanner we're working on as well. Should be released very soon. It's just phenomenal. Let's just, for example, I've already got euro dollar selected, okay? But on our spread scanner, any of the instruments you select, all you got to do is pull it up and it tells you right here, okay? Nadex ticks like this, euro mini lot ticks like this, 6E future ticks like this, and it shows you very quickly how to figure out how many spreads you need to equalize what you're trading, okay? Because if you're trading a oil contract, oil futures contract that is $10 a tick, then you'll need 10 Nadex spreads. If you're doing ES, you need 5 Nadex spreads to equal it out, to make sure you're covered dollar for dollar. You can easily find that there on our scanner. What's the other nice thing about our scanner? Well, I selected the euro dollar, okay? And look what happened here. It pulls up all this stuff. Buy, sell. What does all this mean? Well, real quick. Expiry minutes. How many minutes to expiration? Easy. Width. 100 tick wide spreads, 250, 600, shows you that. This is all euro dollar because that's what I selected. The bottom number is the floor, the top one's the ceiling, right? Bottom one's floor, top one's ceiling. When do they expire? 8 p.m., 11 p.m., 3 p.m. And then it shows you right away the price you can buy or sell them for, bid and offer. And right here, your max risk, your max profit, all on one page. Why is that important? Why would you need this tool here? Well, let's say that you're trading the euro dollar, you've got your chart up in front of you, market starts to go long, you're ready to enter an order. What do you got to do? Okay, well, I want to do that little hedge strategy thing that I saw in that webinar. So let me go to the Nadex platform. Let me select Forex spreads, euro dollar. Well, I don't know. Which one do I want? Do I want that daily one tomorrow? Well, let's see here. That floor is this. That ceiling is this. I can sell it for that, buy it for that. I don't know. Let's check out 6 to 8. Okay, these are 100-point. Okay, wait a minute. Here's the floor and here's the ceiling. What are those? Okay, let me go and look at this one. Well, this is a little bit different floor and ceiling because they're wider spread. Wait a minute. What was that other one again? Let me go back. The trade took off. You're going back and forth trying to figure out which one to get. Where's the floor and ceiling? What is the bid and offer? How much premium is in here? How far is the offer away from where the indicative is? Let me run some math. I mean, you're going everywhere, right? Or you just pull up the scanner and it's all right there in front of you. Every spread that you can buy. All right? Okay, I want to go long. Okay, here's all the spreads I can buy. Okay, proximity. What does that mean? It's premium. How far away is it from the market? That's 1 tick away. That's 4 ticks. That's 3 ticks. Okay, here's my max risk. I'm looking for one that's really cheap and near the floor. Okay, look. All right, $10. Great, that's the one I want. Boom, in it. It's doing all the math for you. Okay, it's all right here on one page, one screen, easy to see. Calculates it for you. You're not going back and forth between a bunch of tabs trying to remember what you had and didn't have and what works and doesn't work for you. Okay, so that's one of the tools, one of the huge big tools we use for, first of all, finding out how many spreads you need to equalize the instrument you're trading, and easily find the best spreads, see them all in one easy place, calculate it all, no going back and forth. Okay, so real quick, just remember the hedge is to the floor. If you're going long on an underlying position like a spot Forex contract, or it's to the ceiling if you're going short. So just remember, you're not hedged past that floor or ceiling depending on which way you're going. And you will need 2 separate accounts to do this. You will need money in your futures or Forex account, and you'll need money in a Nadex account. This will be two separate accounts here, okay? Let's see here. Lasamo, you're asking about your profitable trader. How can I make this with binary options? Yeah, Cam answered that there. We've got a ton of information over on our website. I'll show you where you can get some of that information on binary options. We're mainly covering spreads tonight, and I'm kind of coming down to the wire here. I know Cam and Jan are going to start hollering at me, so I got to keep rolling. But before I'm done, I'll show you where you can get some quick information. So you can take this now and implement it. I think you guys see the value of it. You can eliminate these whipsaws, hide your stops, have stop losses for penny on the dollar, and protect your profits. So real quick here, how do we use NinjaTrader? What are some of our Apex systems and indicators? Then I'm going to show you how to get free deviations. I'm going to run through this really quick. So one of our trend trading strategies we call our profit hunter, which is basically, you know, when prices below these lines that are all add up and the colors all line up just properly with bar colors, we're going short. If it comes above these lines and everything lines up with a certain number of bars, we enter long. Here we didn't and wouldn't have. Here we're going short again. Here we're going long, and so on. Again, I'm breezing through this. We have our trend catcher system. Trend catcher is these little arrows here. Trend catcher is what we call it shows us the immediate trend of the market. It's not a long-term trend system. It's showing the immediate trend of the market. As you see here, these arrows down, you see there's arrows up, showing you a quick reversal. This is if you're more of a short-term trader or scalper, okay, is how we kind of utilize this, our trend catcher system. We do this all in NinjaTrader. We have our Apex Elite system. This is kind of our main Apex system that you're probably familiar with. The APEX, basically it's calculating the higher highs and lower lows mixed in with about 10 other formulas. When we get an A, it's alert, P is pivot, get ready, and we enter 3 ticks above an E. Obviously, the green E's are long. This line, our MVP lines, are lining up long. Here's an example here of how we do that. We get in long and follow it all the way up until it comes back down below our MVP lines there. You see another example there of a short. We never enter on the first apex. We let it fully flip and confirm. We enter on the second one for our longer term trend trading. So quick example here. Market was coming up and down. Boom. We've got long green MVP. We've got our first apex and our second apex. We want to go long. We want to go long on a futures contract. What will we be looking to do with this strategy we just talked about? Well, when we're entering right here to go long and follow our trending apex pattern long, we'd be looking for a spread that has a ceiling somewhere right in here for us to sell spreads going short. To protect us in case the market didn't go long, it came back and went short. That way our position is hedged, right? Opposite example, when the market turns around over here and we're going short, we'd be looking for a spread that has a floor here so we can sell spreads long while we're going short on our futures contracts. Just a couple quick indicators that we use here at Apex. This one here is called our expected range. See these square boxes? If you notice, you look at the time frames, these are hourly. This goes from 9 to 10, 10 to 11, and so on. These are set on hourly ranges. What these are is an indicator that we have that's basically a historical expected movement of the market for this time period. This day of the week and for this time of the day, you know, from the 9 to 10 hour, the expected historical move of the market is not outside of these boxes. The market normally doesn't go outside, above here, or below here. And as you can see, every new hour, if you have it set on hourly, every new hour it'll plot the next hour's out expected range. As you can see, it does a great job of staying in between those ranges, and they're super powerful. They help us a lot to know the expected move of the market. They also help us to know what size of spread do we need. Do I need a bigger spread? Do I need a spread that has a larger floor and ceiling? Because, you know, this is on NQ for example, the first couple hours of the morning, look, those are much wider expected moves, obviously. We all know how the market can move in the morning. Then we get to lunchtime, they're smaller high to lows. So maybe I can use smaller spreads. Just kind of helps you with that. One of the other big indicators we use here on NinjaTrader is our expected volume indicator. See this yellow lines? The yellow lines is the expected volume historically for that hour and minute of the day. I think it's set on 4 minutes. What's the expected volume? That's historical, the yellow line. The blue here is the actual current volume. So like right here in this example, volume is lower than expected. Volume is lower than it historically normally is. And you'll see that most of this day, volume was lower. And therefore, look what's happening. Price is staying within the range. Check this out. What about high volume days, where the volume's blowing past these expected lines? You see that? High volume, choppy, volatile days. Guess what happens? Boom, coming out of ranges. Boom, coming out of ranges, going out of ranges. Just a couple other tools we use for our trading. Whether, no matter what system you're using for trending, we use these ranges and volume for a lot of our systems because it's great to know what the expected move of the market is and what the volume is, and you'll see the correlations there. It'll help you with any trend trading, but also the ranges will help you to know kind of what spreads you might be looking for, what's realistic. You can also set these ranges to not just an hour out, you can set them out to 3 hours out or 4 hours, whatever your trading time area is. Like I said, those ranges can go anywhere from an hour to 3 hours, whatever you're looking at. Deviations, these are so powerful. These are looking more at the whole day's expected move, okay? And these plot directly on NinjaTrader charts. It shows settlement, and it shows plus 0.5 deviation, plus 0.7, plus 0.1. Then underneath there would show, minus 0.5, minus 0.7, and so on. These guys are incredibly super accurate. You can slap them on a chart and see they're incredibly accurate. Right here, for example, you see the market popped up. When it hits about a 0.5, those are kind of good resistance and support level. The market kind of bounces, goes on up, gets almost at 1 deviation, comes right back down. And you can see as it goes down, kind of bouncing off these areas, bouncing off these areas. Great place to know, to expect a little bounce in the market, to know where to possibly trail stops and put stops. For example, here the market went to settle, was a settlement, went up to 0.5, came all the way down to negative 1.5. It was a 1 deviation move, then came back up. All right. What are deviations? It's the IV of options for that particular market. We plug it into a special deviation formula, and it's kind of what does the market expect the market to do going forward. This isn't like other deviations you've seen. This isn't historical deviations based on historical prices or historical pivots and what's happened in the past. This is what's expected going forward based on what options are priced at, based on the options of the market. That's people in the market putting their money where their mouth is of what they think the market's going to do, where it's going. So deviations are great to know when to tighten your stops or take profits, or know when not to enter again. If we've already made a 1 deviation move and we're at the top, your chart may give you another buy signal, but do you really want to do that? You don't want to be buying at the highs or selling at the lows. It also shows you what is a realistic profit target. Not a max profit or what you could make. It's realistic. Helps you with reversal plays, knowing what spreads to pick, what binary option strike prices you might want. There's several strategies we have on that. This is just kind of example here of kind of piecing it all together. All our different indicators and you can see it well on this one here. Market was at settlement, popped right up, started hitting, hesitating about 1 deviation, came right back down. So even though we got another entry right here, another apex, we're at 1 deviation move. We're not going to take that entry there, and we're glad we didn't, right? So basically, you have a 76% chance of the market going and breaking through at a 0.5 deviation. You've got a 32% chance that it'll break past a 1 deviation. You only got a 5% chance to go past 2 deviations, and hardly any chance of it going at 3 deviations. So gives you a good time to know, when to stay out and when to stay in, when to tighten up. Okay, so guys, again, get a demo account with Nadex. Practice this system. If you go to ApexInvesting.com. You can join now for free. You can sign up, get a free username and password, free access to hundreds of hours of education on spreads, hedges, other general info, get full access to our forum, our news trading plan, and you can download our toolkit for free that will give you those deviation levels plotted directly on your NinjaTrader chart for free. It's on over 22,000 instruments. So go to apexinvesting.com, join for free now. When you're on Apex Investing, I'm almost out of time here. I just want to show you real quick where to go. Then I'll hand this back over. Hop on over to apexinvesting.com. Like I said, no credit card required, no obligation. Get a free username and password. You get full access to all the education. Just go right here and then go to this option here of download. And you can scroll down and it'll say download the Apex Toolkit. Okay, let me just minimize real quick. I just want to show you all where to go. You'll go right here, download and install the Apex Elite Toolkit. Our toolkit works only on NinjaTrader. Okay, Yana just posted the link right there that you can click on. That'll take you right to the sign up page. Again, no obligations. Get a user and password. Download the toolkit, and then once you have that on your NinjaTrader, you can load those deviation levels on over 22,000 instruments. And like I said, doesn't matter if you're using any of our systems or your own, just add it straight to your own. You can just let that help you with whatever strategy or system or indicators you're already using to let you know those high and low levels, and it's absolutely free to use. Okay, so if you have any questions on this, lots of information on our site. I promised someone a minute ago I'd show them where. If you go right here to the questions tab, these are active Apex investing courses. We have step-by-step training courses on binary options and spreads. And then our trading questions forum, you can go in there and type in the search button, spreads, binaries, hedges, butterflies, straddle, strangle. You'll have literally hundreds of hours of information in there for that. So folks, I appreciate y'all taking time out of the evening here. I hope this helped you and gave you some new ideas, new things to check out. I'd like to thank Raleigh and Cam and Yana over at Trading Pub for helping put this all together, and Wesley over at NinjaTrader. We sure appreciate the opportunity to share. So
well, I tell you what, John. Yeah, John, thank you so much for that fascinating presentation on trading Nadex spreads. I think for many